What's going on? We're going to bring in Ajay Rajadhyaksha, head of U.S. fixed income strategy at Barclays Capital, which is the second biggest underwriter of U.S. debt. Good morning to you, Ajay. I want to ask you, I had Dan Fuss on this show a little bit ago, and he said he was steering clear of treasuries at that time. He didn't want to buy the debt of the biggest issuer out there. Why are so many others hungry to right now?
Well, let me first start by saying I understand his position, and I think the reason that he's saying what he's saying is because the U.S. fiscal situation, the deficits that we are running, not just this year, but over the foreseeable future, put us squarely in company of some of the names, some of the sovereigns in Europe that currently are facing funding problems, right? We are getting a free pass, but the question is how long that continues. So then to the second part of your question, I think there's two big reasons why yields are at these low levels. One is because there's a massive amount of risk aversion still out there coming from Europe. There's a lot of cash on hand, and that cash has to go somewhere. And for now, the belief is that the US is still rock solid as a credit. The other reason is the Fed just told us that it plans to give the carry trade an extended lease of life. You as an institution, your cost of funding is going to stay low for a long time. Then even if 10-year treasuries are at 3%, that still means you're getting 250 basis points of net interest margin, which is pretty good. So that, I think, is the other reason.
So would you or would you not consider them to be overbought?
I definitely think they are overbought. I understand why they are overbought, but I think that as risk aversion starts to abate a little bit, as people start to get a little more confidence, not just in the economy, but more importantly in the belief that Europe is not going to blow up, treasury yields start to rise, bond prices start to fall.
Ajay, that just doesn't sound like what we're hearing, though, in the news cycle, right? Particularly after a slew of economic data this week, particularly on the housing front, raising new concerns about a double dip. Once again, we were reminded about the heavy debt loads in Europe this week. When is it that you're expecting this risk aversion to retreat?
So two things. One, it'll recede slowly. You know, I'm by no means suggesting that we are going to see 10-year treasuries rise by 50 basis points over the next month or so. And second, we think it starts as early as July, when we come back from the long weekend, because that is the point at which we should start to see, we believe we'll start to see data turn for the second quarter. The other thing I should point out, it's funny you should mention the housing numbers. Yes, they were very weak, much weaker than most expected. But we also think that those numbers are not a true indication. And the big reason is because you look at pending home sales, for example, which tells you how many contracts were signed. That usually does a very good job of telling you where existing home sales are coming. This 1 month, things just completely went askew. And the big reason we think for that is because short sales are now starting to become an increasing part of existing home sales. They just take more time to close, period.
Who's doing the buying?
It's coming from a couple of sources. One is there are still investors who are part of the buying. The second, though, is it is simply pent-up demand. Very few houses were bought in 2008 and 2009, and household formation in the United States still runs at about 1 to 1.5 million households a year. What that means is if they didn't buy in 08, if they didn't buy in 09, you have a couple of million households or demand of that sort that is piling up.
Ajay, thank you for giving us your analysis there. Joining us from Barclays Capital this morning, Ajay Rajadhyaksha.